Europe's energy gamble, the winter that changed everything. So picture this, early December 2025. The halls of Brussels are filled with an almost euphoric sense of achievement. European politicians gather for what they're calling a defining moment in the continent's history. The cameras flash, the speeches soar. They've done it, or so they claim. A complete, irreversible separation from Russian natural gas. It's December 3rd when the announcement is made, and just over a week later, on December 11th, the measure passes with resounding support. The media erupts with bold declarations. Europe turns off the tap. Energy freedom realized. But beyond the celebration and the carefully worded press releases lies a far more complex and unsettling reality. This wasn't merely a symbolic gesture or diplomatic posturing. What European leaders had just enacted was a legally enforceable deadline, a ticking clock that would fundamentally reshape the continent's energy landscape, whether it was ready or not. Let's examine what this actually meant in practice. For liquefied natural gas, the LNG that arrives aboard massive tankers crossing oceans, the spot market purchases would be prohibited starting in early 2026. Any existing long-term contracts with Russian suppliers had to be completely dissolved by the first day of 2027. But the restrictions went even further for the gas that once flowed steadily through underground pipelines, the kind that used to arrive via routes like Nord Stream. Short-term agreements for pipeline gas had to cease by the middle of 2026. And the long-term pipeline contracts, the massive multi-year deals that entire national energy strategies were built upon, these had to be terminated no later than the end of September 2027. Take a moment to absorb the magnitude of this decision. This wasn't a gradual phase out. This wasn't a flexible framework with room for adjustment. European leaders had effectively legislated an expiration date on decades of energy infrastructure and supply relationships. They framed it as liberation, as energy sovereignty finally achieved. But in truth, they had declared something far more dangerous, an all-or-nothing wager on their ability to completely transform their energy system without a single major disruption. They had lit a fuse on a tightly packed explosive, then stepped back with absolute confidence that detonation was impossible. They were betting the economic well-being of nearly 450 million people on a flawless, crisis-free transition. And in that room of champagne toasts and congratulatory handshakes, the countdown had already begun. Now, you might assume that such a monumental decision would be backed by rock-solid unity across all 27 member states. You would be wrong. In fact, before the signatures had even dried on the historic agreement, the facade of European solidarity began to crumble spectacularly. Two nations didn't just express reservations or request minor modifications, they outright rejected the entire plan. Hungary and Slovakia. The Hungarian foreign minister's response was swift and uncompromising. He declared publicly that his nation could not, and would not, comply with this mandate. His government announced plans to file a lawsuit against the European Union itself, taking the matter to the EU's highest judicial authority, the Court of Justice. This was no quiet diplomatic protest. This was open defiance from inside the family. But why such dramatic resistance? Why would two member states risk political isolation over an energy policy? The answer is brutally simple. Geography and infrastructure. Hungary and Slovakia are landlocked nations. Unlike coastal countries that can build LNG terminals and receive shipments from anywhere in the world, these countries had spent decades building their entire energy systems around direct pipeline connections to Russian gas fields. There are no ports. There are no terminals. They can't simply redirect an LNG tanker to their doorstep. In previous rounds of EU sanctions, both countries had been granted special exemptions precisely because of this physical reality. This new total ban eliminated those exemptions entirely, cutting off their primary energy lifeline with no viable alternative in sight. So the very first consequence of this bold declaration wasn't damage to Moscow's economy. It was a legal and political civil war erupting within the European Union itself. The united front that had been presented to the world was revealed as a fragile illusion. It exposed an uncomfortable truth that becomes clearer with every crisis. When survival is at stake, national self-interest will always override collective ambition. The grand vision of unified energy independence was fractured from day one. And if the bloc can't even maintain internal agreement on the fundamental plan, how can anyone expect it to weather the brutal consequences that plan has now set in motion? With the deal finalized and internal dissent already simmering, European officials launched a coordinated public relations campaign. The message was clear and carefully calibrated. There's no cause for alarm. We are thoroughly prepared for this winter. It was classic crisis management: project confidence, calm the markets, reassure the public. But here's the problem with energy security. It's not built on confidence. It's built on cubic meters of stored natural gas, on functioning infrastructure, on hard data. And when you actually examine the data as winter approached, a very different and deeply troubling picture emerged. Let's talk about Europe's gas storage facilities. Essentially, the continent's emergency energy reserve, the cushion against supply shocks and extreme weather. For years, the European Union maintained a strict, non-negotiable requirement: storage facilities must be at least 90% full by November 1st, every single year. This wasn't arbitrary bureaucracy. This was the mathematical safety margin that ensured homes could be heated and industry could function even if something went wrong with supply. But as 2025 progressed, something interesting happened. EU officials quietly revised this standard. They introduced a range, 75% to 90%, giving themselves considerably more flexibility. Some observers noted this change with concern, but it largely flew under the radar amid bigger geopolitical headlines. Then came early December, right as European leaders were declaring victory over Russian gas dependency. The actual storage level across the EU was sitting at just 68.2% of capacity. Read that number again. Not only had they failed to meet the original 90% target that had been in place for years, they had fallen short of even the bottom threshold of their newly relaxed standard. This level was roughly 17 percentage points below the 5-year average for that time of year. This is what we call a dangerous gap between political narrative and physical reality. Imagine a city celebrating that it's finally fixed all the cracks in the dam, all while the reservoir behind that dam has dropped to historically low levels. The system wasn't well prepared. It was running on a deficit before the harshest months had even arrived. European energy security heading into this winter wasn't built on a robust surplus or comprehensive backup plans. It was built on hope. Hope for a mild winter. Hope that global LNG supply chains wouldn't face any disruptions. Hope that nothing, absolutely nothing, would go wrong. They were entering the coldest, darkest months of the year, with their shield already badly damaged, telling everyone they'd never been stronger. While politicians gave optimistic press conferences and engineers nervously monitored those declining storage numbers, a different group was making an enormous calculated gamble on this winter's outcome. In the high-stakes world of energy trading and financial speculation, the so-called smart money was taking a position of unprecedented size. Investment funds and major hedge funds had established what's known as the largest net short position on European natural gas prices since the summer of 2023. What exactly does that mean if you're not fluent in financial jargon? It means these billion-dollar trading firms were wagering enormous sums that European gas prices would decline. They were betting that winter weather would be moderate, that LNG shipments would arrive smoothly and on schedule, and that no major crisis would materialize. From their perspective, the politicians' confidence was justified. In the short term, this massive bet actually has a stabilizing effect. It can help suppress prices and create an atmosphere of calm in energy markets. But here's where this becomes incredibly dangerous. This isn't a stable, low-risk investment. It's a highly leveraged trap with a hair trigger. If the weather forecast shifts, If a prolonged, severe cold snap sweeps across Europe, the kind meteorologists call a beast from the east, everything inverts instantaneously. Heating demand skyrockets. Those already low storage reserves deplete at alarming speed. Market panic sets in. The funds that bet billions on falling prices suddenly face devastating, portfolio-threatening losses. To limit the damage, they're forced to rapidly purchase gas contracts to close out their short positions. This phenomenon is called a short covering rally, and it's critical to understand that it's not driven solely by actual energy demand. It's driven by financial terror, a stampede of traders desperately trying to exit losing positions all at once. The result? Prices don't just increase. They can explode upward by 200%, 300%, even more within a span of days. The market doesn't gradually adjust. It detonates. So on top of a physical shortage of stored energy, Europe has voluntarily constructed a financial time bomb. And the detonator? It's being held by the weather itself, something no politician, no central bank, and no trading algorithm can control. Now this is where the narrative becomes genuinely contradictory, where the rhetoric of energy independence starts to look less like reality and more like a carefully managed public relations strategy. Because while European officials were making international headlines for banning Russian pipeline gas, a massive flow of Russian energy was still quietly moving into European markets. In fact, in November 2025, just weeks before the dramatic ban was announced, the European Union had established itself as the world's single largest purchaser of Russian natural gas. Let's unpack these numbers because they're striking. For Russian LNG, the liquefied gas shipped on tankers rather than through pipelines, an astonishing 49% of all Russian exports were being purchased by EU member states. For the pipeline gas still flowing through routes via Turkey and Ukraine that hadn't been shut down, 35% of Russia's total exports were heading to Europe. When you calculate the overall picture, Russian gas still accounted for approximately 13% of the European Union's total gas imports throughout 2025. So this total break wasn't remotely total. It was a transition from certain types of contracts to others, but the fundamental dependency remained largely intact. And there's another critical dimension to this story that receives almost no attention in mainstream coverage: fertilizer. Europe imports vast quantities of nitrogen-based fertilizers, and the primary ingredient required to manufacture those fertilizers is natural gas. A substantial portion of these fertilizer imports come directly from Russia. This isn't just about keeping homes warm during winter. This is about agricultural productivity. This is about food security. It's a perfect, devastating contradiction built into the entire independence narrative. Europe can publicly declare it has ended Russian energy imports, but if it still fundamentally depends on Russia to help fertilize the crops that feed its population, then it hasn't achieved independence at all. It has simply relocated the dependency from the electricity grid and heating system to the foundation of the food supply chain. The tap wasn't actually closed, it was just rerouted through a different valve, one that flows directly into one of the most essential elements of economic stability and human survival. You cannot operate a modern, complex economy on political slogans and expensive energy. And that harsh reality is now crashing into Europe's industrial core with devastating force. We're no longer discussing abstract market theory or political statements. We're talking about concrete consequences: factories going dark, production lines stopping, jobs disappearing. This phase is known in economic terms as demand destruction, and it's crucial to understand that this isn't a temporary cutback during tough times. This represents a permanent migration of industrial capacity away from Europe. Consider the industries that form the backbone of any advanced economy: fertilizer manufacturing, petrochemicals, glass production, metals processing, including steel and aluminum. These operations are extraordinarily energy intensive. When their natural gas costs double or triple, their entire business model collapses overnight. These aren't businesses that can simply reduce expenses elsewhere or wait for prices to normalize. So what are they actually doing? They're not just reducing output or operating at lower capacity. They are permanently shuttering production facilities. They are mothballing plants that took decades to build. And most critically, they are making strategic long-term investment decisions to construct their next generation of facilities not in Germany, France, or Italy, but in the United States, where energy remains comparatively inexpensive, or in Asia, where supply is more reliable and long-term contracts are still available. This is the silent, slow-motion deindustrialization of Europe. Every factory that closes isn't merely a loss of current economic output. It represents the erosion of decades of accumulated technical expertise, the loss of thousands of high-paying skilled jobs, and a permanent reduction in the continent's productive capacity that may never be recovered. The capital, the talent, and the jobs are migrating, following the energy to more hospitable locations. So while politicians continue their legal battles in Brussels and debate the fine points of regulatory frameworks, the very industrial infrastructure that built Europe's economic prosperity over the past century is withering away. The energy crisis has evolved beyond a question of utility costs. It has become a structural economic transformation. Europe isn't just risking an uncomfortable winter. Through these policy choices, it is actively selecting a permanently diminished economic future. The shockwaves from the energy crisis don't stop at factory gates. They extend all the way to the foundations of European financial power, the euro itself. The common currency was designed to be a pillar of stability, a legitimate rival to the dominance of the US dollar in global finance. But you just can't maintain a strong, stable currency when your entire economy is built on a foundation of expensive, unpredictable energy that must be imported from distant markets. This is the brutal economic mathematics now systematically undermining the euro's strength. Here's the mechanism. Europe is forced to purchase enormous volumes of LNG on the global spot market, and these transactions are conducted in US dollars. This creates constant, massive demand for dollars, which means European entities must continuously sell euros to acquire the dollars they need to buy energy. This mechanic alone creates persistent downward pressure on the euro's exchange rate. A weakening euro might initially sound beneficial. It makes European exports cheaper and more competitive internationally, and it makes Europe a more attractive tourist destination. But for an economy in Europe's current position, a weak currency is catastrophic. It makes absolutely everything Europe must import: energy, raw materials, components for manufacturing, food products, immediately and significantly more expensive. This directly imports inflation into the economy, hitting both consumers who see rising prices at the grocery store and businesses already operating on razor-thin margins due to high energy costs. This places the European Central Bank in an impossible strategic dilemma. Should they raise interest rates aggressively to combat inflation, knowing this will further crush an already struggling economy and potentially trigger a severe recession? Or should they keep rates lower or even cut them to support economic growth, fully aware this will allow the currency to weaken further, making the energy import bill even more expensive and fueling more inflation? There is no good option. Every move has severe negative consequences. The energy crisis has metastasized into a currency crisis, steadily eroding Europe's financial sovereignty, diminishing its global purchasing power, and quietly but unmistakably reducing its standing as an economic superpower. The economic strength that took decades of careful integration and policy coordination to build is now being drained away, megawatt by expensive megawatt. As the continent pays premium prices for energy it used to receive at a fraction of the cost. While Europe turns inward, consumed by the management of its self-inflicted crisis, the rest of the world is certainly not standing idle. A profound and historic shift in global economic power is accelerating, and it's centered overwhelmingly in Asia. This isn't about military aggression or territorial expansion. This is about cold, calculated pragmatism, about recognizing a historic opportunity and seizing it decisively. As Europe deliberately steps back from Russian energy supplies for political and strategic reasons, other nations are stepping forward aggressively to secure their own energy futures for the next several decades. Look at the strategic moves being made. China and India have rapidly emerged as the new anchor customers for Russian oil and natural gas. They are negotiating long-term supply contracts at highly favorable prices significantly below what Europe is now paying on volatile spot markets. These aren't ideological statements. These are ruthlessly smart economic decisions designed to fuel continued growth and development. In the process, they are locking Russia into a new Eastern-oriented energy alliance, fundamentally reorienting global energy flows away from their traditional westward direction. Simultaneously, major LNG producers like Qatar and the United Arab Emirates are no longer operating as passive commodity sellers. With European nations now desperate for supply and essentially forced to accept whatever terms are offered, these Gulf states suddenly wield unprecedented leverage. They can dictate pricing, set delivery schedules, and choose their preferred long-term partners. They have transformed from suppliers into kingmakers. The crucial distinction here is long-term strategic planning versus short-term crisis management. Asian nations are making massive investments in pipeline infrastructure, LNG terminals, storage facilities, and signing 20-year or even 30-year supply agreements. They are building genuine energy security brick by brick. Europe, by stark contrast, is trapped in month-to-month purchasing on volatile, expensive spot markets with no long-term price certainty and no guaranteed supply security. This is where the real power shift is occurring. It's not happening on battlefields with tanks and missiles. It's happening in boardrooms, in trade ministry conference rooms, in port construction projects and pipeline route negotiations. As Europe's global influence contracts under the weight of its energy crisis and internal divisions, a more confident, resource-secure Asia is steadily filling the vacuum, fundamentally redrawing the map of global economic and political influence in ways that will shape the 21st century. Eventually, inevitably, this abstract crisis of policies, market prices, and geopolitical power shifts lands exactly where such crises always do, on the kitchen tables and in the living rooms of ordinary people. The economic devastation isn't merely a news headline or a statistic in a government report. It's the heating bill that arrives in January showing a 150% increase from the previous year. It's the grocery bill that's 20 or 30% higher because of fertilizer costs being passed down the supply chain and currency devaluation making imports more expensive. It's the factory worker who receives a layoff notice because the plant can no longer operate profitably. This is precisely the point where economic pressure fractures the social and political foundations of society. We've witnessed this pattern play out before across history. When energy costs skyrocket, they trigger a broader cost of living crisis. That economic pain transforms into public anger. That anger searches for targets, for someone to blame, for simple explanations to complex problems. It manifests as strikes that shut down transportation and public services. It appears as protests that fill city streets. It fuels a powerful wave of populist and nationalist political movements that sweep across the continent, promising simple solutions and scapegoats. The blame game begins in earnest and spreads like wildfire. Brussels bureaucrats blame national governments for failing to diversify their energy sources quickly enough. Northern European countries blame southern nations for fiscal irresponsibility and not contributing their fair share to collective solutions. Western nations blame Eastern members for being naively dependent on Russian energy for too long. Eastern nations blame Western powers for imposing policies that ignore their geographic and infrastructure realities. The very foundation of European solidarity, the shared sense of common purpose and mutual support, that was supposed to be the glue holding this ambitious project together during times of crisis, gets tested to its absolute breaking point and beyond. the energy crisis morphs seamlessly into a political crisis that paralyzes the bloc's ability to respond with either unity or decisive strength. A continent that is turned inward, consumed by internal arguments and recriminations, cannot project power, stability, or leadership on the global stage. It's too busy frantically trying to extinguish the fires burning in its own house to have any influence beyond its borders. The crisis has revealed that the European project, for all its achievements and ideals, remains fragile when fundamental interests collide with collective commitments. So, where does all of this leave us as we look beyond this immediate winter and toward the years ahead? The story that began with a single momentous vote in Brussels doesn't conclude with a neat resolution or a return to normalcy. It ends with a fundamental realignment of global power structures. Europe's winter of crisis is not an endpoint or a temporary setback that will be overcome once temperatures rise in spring. It is a powerful accelerator of changes that were already in motion, a stress test that has exposed deep fractures in the post-Cold War global order. The crisis has demonstrated with brutal clarity that the era following the collapse of the Soviet Union, a period characterized by a single dominant Western-led international order, by the expansion of liberal democracy and free markets, by the assumption of American and European primacy, is conclusively finished. The energy crisis has functioned like a diagnostic test on the global system, and that system has fractured decisively along new fault lines that define the emerging century.